COMEX is becoming a price taker. You'll look at the chart and you'll go, but we're going down. Don't be fooled by today's short-term chart chatter. That's all it is. This is the last kick at the can ahead of Basel III US compliance at the end of this quarter. Now, physical market liquidity actually has now migrated to Chinese-anchored BRICS-facing exchange. China anchors these exchanges. China has now become the physical dog wagging the COMEX tail.
For decades, the true value of precious metals has been buried beneath layers of derivatives, manipulation, and digital distractions. Gold and silver, once the foundation of stable economies, have been reduced to speculative tokens on leveraged exchanges, divorced from the physical reality they once anchored. Price action is no longer a reflection of scarcity or demand, but a product of digital paper shuffling, where market makers pull levers behind the curtain and speculators gamble with synthetic positions. But that illusion is fracturing. The gap between the real and the represented is widening, and those watching closely can see where the pressure is building. Gold's short-term corrections are not signs of weakness. They are symptoms of a paper-based pricing system losing its grip. In this new environment, understanding the forces behind the curtain is more important than ever. In today's video, precious metals expert Andrew Maguire breaks down the truth behind recent movements in the gold market. While Western investors panic over price dips, he reveals what's actually unfolding beneath the surface, a desperate, final maneuver by COMEX-based insiders before long-awaited regulatory changes come into force. As Basel III compliance creeps closer in the United States, the leverage-fueled casino of the COMEX is becoming unsustainable. Speculators with just 4% skin in the game, backed by nothing but borrowed chips, have been calling the shots for too long. That era is ending. More importantly, Maguire explains how a global shift is already underway, one that most investors are missing entirely. The East, led by China and the BRICS nations, is no longer waiting for the West to correct course. They're building physical exchanges where gold must be bought, titled, and settled before it can even be offered for trade. These platforms are not speculative arenas, but markets built on weight, delivery, and accountability. With China now anchoring these physical markets, we're entering a historic phase. The East is becoming the price setter, and the West, the price taker. The COMEX can no longer dictate gold's narrative. This shift will reprice not just gold, but the balance of financial power itself. As we present clips from the video, please like and share this video, subscribe to the channel, and turn on the notifications bell for more videos. We appreciate the support and hope you enjoy the video.
Following our last market episode, that was recorded on the 30th of April, we've evidenced some very large tariff-related volatility. But as central banks are strong price insensitive buyers, they'll just buy at whatever the price. The sell side of this volatility that we're currently witnessing, it really is driven by speculators who are merely racing from pillar to post. They're hopping into safe havens, better buy risk, and then sell gold and bonds, and versus the risk markets, basically, which is what we're witnessing right now. And it's this highly leveraged these highly leveraged price-sensitive speculators that drive this short-term volatility we're witnessing today. And let's start by connecting just some of these main bullet points and that under the short-term chart chatter that we're seeing here are driving a series of higher physically supported stair steps. So Shane, let's start with with why gold continues to rally without participation from Western investors. So while Asian ETFs exploded into all-time highs in April, now April alone exceeding all of 2024 demand, when weighing up Western demand as a percentage of BRICS-centric physical demand, so one's paper, one's physical, when you weigh that up, the absence of sufficient Western speculator gold market participation continues to actually limit the scope of COMEX siloed officially orchestrated rinses, of which we're seeing today. Now, while we've just evidenced another round of the ebbs and flows of tariff uncertainty, ultimately this lack of easily flushable COMEX-centric spec open interest, as what it is doing is setting up a perfect scenario for gold to continue to build on its globally determined, physically supported higher stair steps. Now, drilling down, while the PBOC exchanges dollars for gold at every global AM and PM fix, because that's the benchmark where you need, as an auction, you need to have an auction price when you're buying in that kind of size. And so, but they're very disciplined they also know these COMEX-centric events, such as non-farm payrolls, FOMC, options expiry events. And while they're insensitive to price, they use this paper-induced volatility to load up official monetary gold reserves without driving the price higher. In other words, they're alchemizing dollar price paper gold into fully paid for physical 400-ounce bars flowing out of London, unrecorded, and that doesn't require reporting requirements. And a lot of it doesn't appear even in the customs data. We once went through how there are something like 40-something custom brokers exchanges, and this shuffling gets deliberately lost. Also, when the generals buy, and generals control a very large amount of gold, official gold reserves, none of that is reported. That is military. That is what you would call secret. So a quick look at the charts is probably the best way to illustrate this, but liquidity providers reported very large PBOC buying and insurance-related spot gold demand had accrued at spot 3,300. And these very large orders got filled in large size into the Sunday spec-driven sell-off. But we've just evidenced even larger orders than that getting filled into the PM fix today. With spec long ignition largely used up, it's required naked short momentum short selling to provide the short cover for commercials exposed to an upcoming growing wall of T+1 delivery obligations to actually hedge into. Now, net of this past weekend's extreme tariff-driven volatility, it's also not going unnoticed that directly following the one-day Chinese May the 1st holiday, which is when we saw this dip here, we immediately reinstigated the Asia buys physical, West sells paper gold action, and that was back on the front burner. However, given the West selling is heavily leveraged versus Asian exchanges, actually actively arbitraging the synthetic EFP spread, liquidity providers assess that spot 3,200 is where bullion banks exposed to delivery obligations will be long against the momentum short sellers, and today's fix that came in just below that really is where those orders started to get filled, and will have driven the next waiting layer of PBOC and institutional buying. Using silver as an example, it's pretty clear that short-term speculator-driven inverse correlation has developed between the risk markets here and gold and silver. But global liquidity providers report a higher physically supported stair step is being established and is just being established today. And because central banks fill only at the fixes, bear in mind you need an auction to fill large size, so that will have actually been settled today and will require those positions to be delivered. And today marked the first gold fix sub 3,200 since the 10th of April. And the filling of these central bank bullion bids will be short-lived. The lows will be short-lived.
What becomes increasingly clear from this latest market activity is that gold's price trajectory is no longer dictated by speculative flows from the West. Instead, it's being recalibrated by structural, long-term physical demand, particularly from Eastern central banks like the People's Bank of China, PBOC. Andrew Maguire's analysis highlights a crucial divergence. While Western markets remain preoccupied with short-term volatility, driven by derivative-based speculation, macro headlines, and rate expectations, the real price support is being established through systematic accumulation of physical metal. This shift is evidenced by persistent buying during benchmark fixings, which are the only windows large enough to execute size without disrupting market stability. The implication is clear. Physical buyers are no longer reacting to price, but using moments of engineered weakness to increase strategic holdings. The volatility itself, often attributed to events like non-farm payrolls or tariff uncertainty, is no longer meaningful in directional terms. Instead, it serves as a mechanism for physical liquidity providers to exploit imbalances. These parties understand the nature of the COMEX-centric system, that speculative leverage is shallow, and long interest is increasingly fragile. By absorbing selling pressure at critical auction points, they convert synthetic supply into deliverable metal, quietly draining physical liquidity from the Western system. As a result, price support is migrating away from paper-centric exchanges and toward a globally integrated, physically anchored market, one where delivery obligations, not leverage, dictate price stability, and that migration is now visible on the charts. Let's get back to the interview.
This leads us nicely into the second bullet point, which is COMEX is becoming a price taker. You'll look at the chart and you'll go, but we're going down. Don't be fooled by today's short-term chart chatter. That's all it is. This is the last kick at the can ahead of Basel III US compliance at the end of this quarter. Now, Western gold investments are largely represented by highly leveraged COMEX futures-driven speculators seeking to track the price of gold. And to do so, they just have to invest really 4%. And this is a derivative position, which is where you just have 4% of skin in the game. And these are cash-settled investments. They're never designed to be delivered. And they're borrowed from the house market makers. Well, do you figure that's any dissimilar to the synthetically structured world of a casino? I mean, the market makers, the pit managers, loan out this fractionally backed gold, silver, open interest, the chips, as we've said, while taking the other side of these bullish or bearish speculator bets. If they're betting against the house, then the house is on one side. If they're betting with against the house, whatever it is, the house is on the other side. Now, these chips, though, think about it. These chips are not exchangeable outside of the casino. So this is why we called it a siloed market, because everything that you're shuttered in, there is no windows. This is why it's so similar to a casino environment. Historically, this highly leveraged gold derivative structure that could be profitably managed in-house and return a standard 95% win for the house and just enough of a 5% win to keep the speculators trying their luck against the house. Now, this is what led the last 50 years of the gold derivative tail wagging the physical dog price. However, as we've been tracking following the BIS, the Bank of International Settlements, reclassifying physical gold as a first-tier asset class, the global gold price is increasingly being determined by competing BRICS-facing physical exchanges. Now, all the BRICS exchanges require that a gold bar has to be bought, titled to the buyer, and then fully paid for clearly before you can ever offer that for sale. And this is how a real supply-demand globally fungible gold kilobar price is determined by somebody who really is willing to sell it for a price or buy it for a price. There's a balance there. Now, physical market liquidity actually has now migrated to Chinese-anchored BRICS-facing exchange. China anchors these exchanges. China has now become the physical dog wagging the COMEX tail, regularly alchemizing the globally underpriced synthetic price, utilizing the backdoor exchange for physical conduit. We talked about it multiple times. It is the way of getting, it's the Achilles heel, it's the backdoor of the COMEX where you can actually convert an otherwise undeliverable cash-settled COMEX price with only a 4% investment in it, into a 100% paid for, physically settled, T+1, meaning 1-day delivery, NSFR compliant physical bar. Now, as we looked at really most recently, I think at last time, a rush of recent calls from technical traders. They're currently calling for the synthetic gold tail to keep wagging the physical dog. And they're having some success today. What they're doing is chasing moving averages, hunting out, are there any longs or shorts that they can garner at these? This is the house at play. Now, and obviously, while they're doing this, they are either disingenuously talking their own book, which would be officials, spinning the idea that gold should retrace to its historical moving averages and trend lines, which really many people follow. But these trend lines are anchored prior to the 1st of January 2023 Basel III, where it recategorized gold as a first-tier asset class. So the old guard are on the wrong side of an increasingly liquid physical market. And they get little wins, and they're right in the middle, but wrong at both ends. But the open interest, as we've just looked at, is reducing into this process, giving them less and less and less bandwidth to be able to do this. Now, these naked short footprints contradict the strong upsurge of physically settled BRICS gold demand, and they're not going unnoticed. And while these momentums are fueling yet another synthetic market overshoot, they've done it to the upside, they've done it to the downside. They're providing a very welcome discount to Chinese speculators. And while central banks are price insensitive, they also lay in wait to aggregate their bids below round numbers, which we've just crossed today, where they can fly under the radar, and they step up, then swapping dollars for large gold purchases. And that's something we're evidencing now.
For decades, the COMEX and other Western derivatives markets acted as the global price makers, despite their minimal physical settlement. Their game relied on leverage, shallow liquidity, and a house-controlled casino structure where most bets, bullish or bearish, were destined to lose. Gold was traded not as money, but as a synthetic asset, manipulated through a system that required only 4% collateral to exert disproportionate influence over the price. But that system is breaking down. Today, COMEX is becoming a price taker, not a maker. And it's not a coincidence. It's the result of structural forces driven by physical demand from the East, especially from BRICS-aligned central banks and institutions. These buyers aren't trading volatility, they're acquiring sovereignty. They're converting dollar-priced synthetic contracts into fully paid, NSFR-compliant physical gold, T+1, real delivery, real ownership. This shift is especially visible during benchmark price fixings, where enormous orders are being filled under the radar, often hidden from official data. Andrew Maguire's insights make one thing clear. Gold's price is no longer dictated by speculative flows in New York and London. Instead, it's increasingly determined by disciplined, opaque, and highly strategic buying from state actors like the PBOC. Actors who are building monetary gold reserves not to trade, but to settle global accounts in a world moving beyond the dollar. And while Western technical analysts continue drawing lines on charts, chasing moving averages set before Basel III reclassified gold as a first-tier asset, they fail to recognize a more fundamental truth. We've entered a physical gold regime, one where supply must be titled, settled, and delivered, not just promised through paper. So while volatility persists on the surface, triggered by macro headlines, algorithmic trades, or short-term positioning, underneath, a stair-stepping process continues to unfold, one built not on speculation, but on actual demand, not on leverage, but on weight. The West may still control the casino, but the game is increasingly being played, and won, elsewhere. If you're watching the gold price, but ignoring where the real power is shifting, you're only seeing half the picture. To stay ahead of the curve as COMEX loses its grip and physical gold takes center stage, make sure to subscribe for more market breakdowns like this. If this episode gave you new insight into what's really driving the price action, like, share, and drop a comment below. We want to hear your thoughts on how this eastward momentum could reshape global finance. Thanks for watching, and see you in the next one.